Hello, this is Rumela Banerjee, and joining me today is Tanveer Sethi, Investment Manager, Fixed Income Strategies at Kotak Mahindra Asset Management Singapore Private Limited, to discuss the debt market outlook. Hi, Tanveer. Thank you for joining. Let's start with the developments at Jackson Hole, a policy pivot. Are you penciling in a September rate cut?
Yes, at this point, we, like most of the market, is pricing in a rate cut in the next policy meeting by the Fed. I believe that if you look at whether you look at the chairman, Mr. Jerome Powell, or whether you look at across the Fed various members that were available and made comments during the Jackson Hole event, across we have got the sense that the Fed is now ready to deliver a rate cut in September. In fact, some bits of the market are now anticipating a 50 basis points rate cut. At no point of time did the Fed communicate that it probably is 50 basis points rate cut. Neither have they ruled it out. In our opinion, I think the base case would be one rate cut for each of the policy meetings going forward for the remainder of the year. That's probably three rate cuts. I think a lot of the market is pricing in four. But I think what's not material is whether there are going to be 3 or 4 rate cuts in this particular calendar year. I think what is important is as we go along, what is the particular data that comes up from the US and what does the Fed finally communicate as the final rate, the terminal rate of what the policy rates would be. We have seen a little bit of two-way oscillation in the market between the market's pricing in a hard landing versus a soft landing. And we've also seen in the past the CPI inflation and or the core PCE inflation, the preferred gauge of the Fed, and the labor data has always oscillated as well. When one has been strong, the other has been weak, and that data has oscillated. I think now in the recent past, both have convincingly come down. So definitely we are now in a situation where we should expect rate cuts. Some factors which will be post the first rate cut, I would imagine, would be the Fed, the US elections. And I think factors like who would come in, whether it would be Mr. Trump or whether it would be Ms. Harris, and what the policy outlook would be thereof. That could change the outlook of the longer term inflation as well. And eventually not in the first 6 months, but post 6 months, the way the Fed acts.
India's inflation has cooled down quite significantly. What do you make of that?
So India inflation has been lower for a while. We've had the headline inflation around the 5% mark, 5.5% mark, and the core inflation had gone down to 3.1%, and has largely been in the handle of 3.5%. Now, expectedly, in the last couple of months, the food inflation has gone up. That's because of the irregularities that we have on monsoons, and that's a story that we hear every year anyways. But what has happened is that the inflation in food in the last 2 months has been, though much higher, it has been much lower than the corresponding period in the previous year, that is in 2023. So as a result, the food inflation has significantly come down. This number, which was around the 8-9% mark, has fallen to the 5.5% mark. And on the other side, we saw an uptick in core inflation, which one can say was a one-off. We've seen a large increase in tariffs of telecoms. And as a result, the core CPI jumped up quite significantly. And why I say significantly? Because the rate has gone closer to 3.3%, but on a month-on-month basis, it was much higher. But it is still very much within the band. And putting aside these seasonality factors and the one-off that we have seen in core inflation, one would imagine that core inflation continues to be in the 3.5% band in the near term. And the food inflation will again start easing. And the headline inflation should not be materially different from what we had anticipated previously. So yes, the inflation story of India looks good. And from that perspective, we have repeatedly said that the RBI is in a position to cut rates if it wanted. It's probably waiting for the Fed to do so. And I would imagine over the next 6 months, eventually the RBI oblique the MPC would deliver our base case of 50 basis points rate cut.
The Indian rupee has been bucking the trend of Asian currencies. What do you think is the reason behind this?
Indian rupee has not appreciated as much as its Asian peers in the recent past. Now, while that is absolutely correct, if one were to look at the year-to-date performance from the beginning of the year, we notice that other than the Malaysian ringgit and a slight appreciation in the Singaporean dollar, most of the Asian currencies are either flat to have depreciated up to 2 to 3%. And within that group in this time frame, the Indian rupee is one of the better performers. Now, what has happened is, by and large, a story that we have maintained is that RBI has been there at points of time when the Indian rupee is meant to appreciate. The RBI has stepped in and prevented that from happening. Likewise, they've also prevented in the past sharp depreciations and will continue to do so if it were to come to that. So given that the Indian rupee to start with never appreciated as much, I'm not surprised that it is, reverse. It never depreciated so much. I'm not surprised that it is not appreciating either. And if one were to look at the US dollar, if one were to look at the DXY, that had, if I'm not mistaken, was around 101 in the beginning of the year, and it's marginally below 101 presently. Likewise, the Indian rupee has probably depreciated roughly 0.5% on year-to-date terms versus the US dollar. So the rupee has been a better performing asset over the medium term, and the volatility is what has been lower. And if at all, I think that is good for investors. And that is what we continue to tell our investors, that the Indian rupee promises investors lower volatility, probably depreciation of 1 to 1.5% per annum, given the present macro data of India.
How do you recommend foreign investors to invest in India?
So for a while, we have been long oblique bullish on the Indian debt story. Various macro parameters continue to remain strong. At one point of time, there was a little bit of worry on the outcome of Indian elections. That's behind us. The center, we continue to have a BJP-led government, although it's a coalition now. From the policy perspective, the first major policy that we have seen since the new government is the fiscal deficit. In the new budget, the government has budgeted a deficit of 4.9% versus 5.1% in the interim budget. Of course, since then, they've had one-off bonanza from RBI in terms of a higher dividend and slightly higher tax revenues than they had previously anticipated, oblique budgeted. So the important point is that this incremental income that the center has got, they have used it to reduce deficit, as opposed to distributing freebies or subsidies as one would have feared. So clearly there is policy continuity, and we expect no change on that count. India's trade deficit, balance of payments continues to be similar as it was. The current account deficit, we continue to expect roughly 1% deficit for the financial year. As we know, India has been included in the index, leading to a $2.5 billion inflow month on month. And we see that pretty much coming into India. We've already discussed the stability in the Indian rupee on account of these strong macro factors. And lastly, we also have all heard and what S&P has said about the Indian rating. They have changed the outlook to positive, which means that India can potentially be upgraded from its borderline investment grade rating presently. So all factors point to a positive story. The Indian rate story we have repeatedly mentioned is not a runaway story. It's not that you're going to find the rates from presently 680, 690 level. It's not that they're running 2 or 6 or 5%. They probably could anticipate between the 10 and 30 year to be in the band of 625 to 650 over the next 1 year. So there is some a bit of additional gains from duration. But what one could anticipate and expect is a reasonably better carry, reasonably better and less volatile rate story, reasonably less volatile currency story, which would mean the investors should get favorable and good returns over the medium term. So we would expect investors to increasingly invest into India and recommend as well.
Thank you, Tanveer, for that. That's all from us. Many thanks for watching.